Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into the Money Insights Podcast. I'm Christian. He's Rod. We are the Money Insights team. Rod, what's going on, man?
Hey, I am doing great. How about yourself?
Good. How do you feel about that intro in comparison to my normal one?
It was definitely energetic.
With the usual. It was energetic? Okay,
Yeah.
Well, I'll take it. I'll take it. Energy. We like energy. Sorry, I didn't mean to cut you off though, Rod. How's life? How are things going?
Yeah, things are great. I'm feeling really good. Spring is...
Yeah, we just got back from a trip, so we're energized, right?
Yeah.
We've taken a little time off, although I'm going to be honest, Rod, I'm not as energized as I kind of feel like I need a vacation now that I've been on the trip with all the kids, which by the way was super fun.
Yeah, it was. But you always try to make the most of the vacation, so you need a little bit of vacation from the vacation before you get back to real life. And
especially when you're like hoarding 5 kids in this case, and you know that because you've hoarded more than that in your days. Okay, but it was good to see. It was good to see you and Blake and Brennan and the team.
Yeah, so it was a fun trip.
That was always fun. Okay, Rod, today we're talking about life insurance. I don't know if you knew this, but 1, we really like life insurance. And number 2, we know it pretty well. Yeah. So today we're going to talk about the 10 most dangerous life insurance myths.
Yes.
And we're going to debunk them. Okay.
I like it.
We always like debunking things. And we haven't done an episode that's like digging into some of the key elements of life insurance. And so this, I think, will be a fun, interesting, entertaining way to dive into some important topics that will help people kind of continue to build and create wealth in the most efficient, most effective way possible. So, Rod, is there anything that you want to add to my intro before we jump right into the content?
No, I'm excited about getting in on the debunking the myths.
Okay, let's do it. Myth number 1. And this one is one we hear all the time.
For sure.
Right? Myth number 1, life insurance is a terrible investment. Rod, what do you think when I say that?
I think a lot of times it comes up because we're talking to investors, again, especially alternative investors. They invest in real estate. They're business owners. And we're talking about using your life insurance in conjunction with your investing. So they think naturally, probably the first thought they think is, oh, I add this to my portfolio. This becomes another investment inside of the investment portfolio. And then we quickly say, well, actually, it's an investment optimizer, right? We named it that way because it works in conjunction with the other investing that you're doing. You're not diverting money here instead of putting it into the business or the real estate or whatever it is. You're putting it here first and then using it to enhance, to grow your wealth more efficiently than you would if you didn't have this as an additional tool.
So you're almost saying like, well, the way we typically use it is it isn't an investment anyway.
Right. That's right.
It's not even the purpose. Okay.
Yeah.
And I totally agree with that. So that would be like the first way, like the first debunking of the myth is 1, we're typically not using it as the investment, right? I would almost say like it's a more powerful savings tool than it is an investment. And yet, Rod, I'm going to do a full 180 on this, and I'm going to challenge it as if it is an investment. Okay. So let's just say this. Let's just say, Rod, I told you that you could have an investment that got over the next 20 years, a 9% internal rate of return, including tax equivalents, right? And it was just going to be consistent. And over that 20 years, you're going to walk away and you would have gotten a, 9% IRR on your money. How would that be? The question I would ask is, would you say, man, that is absolutely terrible?
No, I would not say that. I would say, well, especially again, when you think about it in terms of the overall portfolio, if you said the best you're ever going to do on any of your investments is 9%, I would think that's probably not what I'm looking for.
That's not great.
Right?
Yeah. It's not going to accelerate the things the way we want it to.
Yeah. But if you said this is really consistent, historically, it just performs and you can expect this over the next, couple of decades, then I would say, well, yeah, as a part of my total overall investment portfolio, that sounds pretty amazing.
Well, and so here's the thing. When it's structured the way that we structure it, and this is an important element, like I know we always have to put this caveat in there because life insurance is designed, which again, when I say that out loud and I think about the normal person, they're like, what do you mean it's designed? Anyway,
Yeah.
the reality is life insurance designed, and it is designed, and it can be designed to create more cash value or less cash value, higher death benefit or less, right? So designed for maximum cash value and with a company that's competitive, right?
Yep.
I can go out and get a 5 to 6% consistent return. And if I'm a high income earner, that ends up being a 8 to 9% tax equivalent return. And so my point here is really just to say, hard for me to look at that and be like, man, that was terrible, especially, terrible investment. I was going to say something bad, but I was going to say a terrible investment. I'm just going to say it. A terrible investment is the ATM deal, right? Yeah. That's a terrible investment, but a 9% 20-year, tax equivalent IRR is pretty dang good. I would feel at least I may not run home like shouting like this is incredible, but I'd be like, this thing has been super solid all along the way. Okay, so here's the good news though. Back to your point, that's not actually why we typically use it. In fact, when we're using it as a standalone vehicle, we typically add leverage to it,
right?
So that we can increase those returns. And when we're using it in the way that you talked about initially, it's more focused on optimizing other investments than it is that actual one. But the good news is all along the way, you're still getting that kind of a return. So anyway, I'm just going to suggest that I think we've successfully debunked the idea that it's a terrible investment because one, if it's structured, now here's the truth in it. And this is where the people who are saying it actually have credence, they actually are accurate. If you build a policy that's designed for maximum death benefit, it is not going to be a good quote unquote investment, right?
At least not while you're
probably living. That's fair. Not while you're living. It's not going to be a good investment in that. It could be a great investment for your family and the people you care about, but it's not going to be a good cash investment because I'm probably going to end up at like 2 or 3%. So maybe 5% equivalent, right? Tax equivalent, which even then you may not say terrible, right? Because that's basically what you go and expect in your bond portfolio, right? So if you, back to your point, if you said, hey, I'm going to put that in the 20% that I typically would have in my bond portfolio, you might actually feel really good about it. So anyway, long and short of it, I don't think life insurance is a terrible investment. And I would say it would take a lot of guts for someone to come in here and be like, no, it's just absolutely awful, especially when you consider that a terrible investment is usually one that loses money. And typically this doesn't.
Yeah.
Okay. Yep. That's the first one. All right. That was fun. Okay, Rod, the next one, buy term, invest the difference is always better. This is just going to be an always ongoing conversation. I'm going to let you take it for the most part.
Well, what's interesting is it's almost like a variation on number one because
that's fair.
They're suggesting that if you're treating your life insurance as your investment, like you're putting money in there and saying, I'm doing this because I want what's going to happen in the cash value, or I'm taking that money and I'm going and putting it in the stock market in a well-diversified portfolio that it's always going to be better to do that, to do the stock investment than putting any money in the life insurance. And now we get back to that whole premise of the people who are saying this are talking about crappy designs of life insurance, right?
Plus, I have to just wonder, like, what's the comparison point? Because, okay, so here's an example. If you said, hey, I'm going to go get a government issued bond and it's getting me 4%. Would someone be like, government issued bonds are absolutely terrible investments. You should just never stay. Probably not. If you said, oh, this is a small portion of my overall portfolio, someone would be like, oh, great. That's a great strategy inside of your portfolio. So again, my head goes back to saying, like, even in the crappy designed life insurance contracts, they're pretty similar to a bond portfolio.
Yeah.
So, but you're right. This is definitely a variation on that. That's why we ended up in that same conversation. Basically, it's a matter of, should I then take the term insurance money, save the cash that I would have put into there? And I think the reality is it depends on how you're investing. So if I was taking the difference, right? If I'm paying for my term insurance and I take the difference and I'm like, I'm super conservative, I'm going to go invest in bonds. Well, then you might as well use the life insurance contract. If you're trying to beat a bond rate, then you might typically be better by investing in or using term insurance and then investing that money in the market, overall, that could get you to a better place more quickly, right? Or you could, who was it that told us this? He said he was going to invest in whole life and invest the difference or something like that. I can't remember the word. It was our old friend, the attorney, Rod. What was his name?
Steve Scabland.
Steve. Yes.
Yes.
Steve. Well, Steve, if you're listening, you get a shout out. But anyway, he said something funny about that. And I thought, like, that's perfect, because that's the reality of it, right? Like, each product has its use. And typically when people are saying the things about life insurance like this, they're just people that don't really know enough about it to talk about it in a like in a meaningful, nuanced way.
Yeah, complete. Yeah. And the other angle of it is that I think what they are saying is we value life insurance. We think people should have life insurance. If you're going to go get life insurance, this is the way you should do it. Yeah. And we're saying, I mean, from that angle, yes, get the right amount of insurance. And a lot of people are surprised to hear from us, well, we do both, right? Yeah. I have my whole life and IUL policies, and I have term, right? I'm going to optimize the policies in the structure of what I'm doing. That the whole idea again of design, I'm being strategic in the way that I use my IUL and my whole life policies. And I want to make sure there's enough death benefit that pays out if something does happen to me, for my family, for the business, etc. So I do both.
Brilliant. Okay, Rod, this is one that does come up, this next one. And I want to make sure that you hit on it right down the middle. Like, no dodging it. We're going right in the middle. Okay, cash value is lost when you die. People do think this because, well, I'm gonna let you just go through the why people think this as maybe a starting point, and then why this is actually a myth.
For most people, they don't come up with this on their own. They think this because they're fed it by certain people out there. Yeah. Dave Ramsey is one that hits on this all the time. And what he's, I'll kind of try to come at it from his angle. Because what he's saying is, if you have a death benefit or a life insurance policy, say it has a $2 million death benefit and you have 500,000 sitting in your cash value. If you were using that as your investment and you're like, hey, look at this amazing $500,000 of an investment that I have, and I have 2 million of insurance, then what he's coming back and saying is, well, you're not going to get the 2 million and the 500,000 when you die, right? You're just, your family, they're just going to get the 2 million. So you don't get both. The cash value goes with what they'll say is the company keeps that. You don't get that. They keep that. And your family only gets the 2 million. It's like, okay, well, that's a funny way to think about it. But in reality, what's happening is, because you have the 500,000, that's the only reason your death benefit is 2 million, right? In other words, the 2 million, the insurance company is saying, oh, we have this 500,000 sitting here in your account. Therefore, we only have to come up with another 1.5 million from somewhere else. So said a different way, you're not actually paying for 2 million of insurance in that example. You're only paying for 1.5 million of insurance. So when you think of it from that angle, you do get both, right? You're paying for 1.5 million, you get that.
If you broke them out, you'd be like, hey, I'm paying for a term insurance policy that's 1.5 million, and I've got my $500,000 of cash. Yeah. And again, people just need to bring those pieces together, because what happens is, again, it's just a super simplistic way of thinking about it, because the whole idea of cash value life insurance is to bring the savings element and the insurance together. Mm-hmm. And so what the product does is it successfully brings those together, but you have to understand the inner workings of it, right, to know whether this kind of a claim is actually truthful. So yes, that's the easiest way to think of it. People just know we're not paying for both. We're paying for the difference between our total cash value and our total death benefit, which, by the way, in our design gets smaller as time goes on. Yep. And we want it to, because we want the cash to grow. Yep. So in our world, we're actually trying to bring those things together to maximize the cash as much as we can. Okay. That was number 3, Rod. Let's this one is actually kind of similar, but the fourth one, whole life is dead money until you die. It's a variation. Maybe I'll take it. Here's kind of my thought on this. When I hear people say that, the first thing that comes to my mind is really just like, they just don't know any better, mm-hmm. right? Because there's very little truth to it. Like, life insurance is I should say this more specifically, cash value life insurance is designed to have living benefits and a death benefit. So the reality is that there's features and benefits designed inside of the contract that are meant to give you benefits all the time that you're living, right? And that's how we use it. Typically, we're talking about borrowing against the cash value to go and invest and accelerate our overall financial world. So again, I think the simplest way to think about it is that if you hear this myth, you just have to know that the people that are saying it have no idea, right? It's just like, I know that's like a really simplistic way to put it out there, but the reality is it's not dead money. It's like very much living money. And all of the ways that we use it prove that out. It's really easy to see people borrowing money to put into investments, to do whatever it is they want. So in a very real way, it's like living, breathing money. This just really has no credence at all.
Yeah. And what a lot of times in the conversations I have just on a daily basis where it'll come out is someone will say, okay, great. So I've put this money in, I've used it to go out and invest. I've created a bunch of extra value inside of the policy, but does that mean it just is going to go to my heirs? I don't actually get to realize the extra benefit that I have sitting in that account. And so then we get the opportunity to clarify, well, no, yes, we're using it for our investing. And then later on, when I get to a point where I'm in retirement, right, I'm creating these cash flows in retirement. Well, this can be an additional source of cash flow in retirement, tax-free cash flow in retirement.
Yeah. And that is huge, right? All the while that we're using it to optimize all of our investments, we're also building a bigger and bigger pot of money that can be accessed for the purposes you're talking about. So yes, like it's just exactly the opposite of this. Not only is whole life not dead, it's very much alive and well. And we can use it in a myriad of different ways. And I would even argue that it's like the most versatile asset that I personally am aware of. I would challenge anyone to find something that's more versatile. I just don't know of anything that exists out there that doesn't. Okay. Right. Number 5, Rod, if you're not doing infinite banking, you're doing it wrong. So this is obviously coming from the infinite banking crowd. Mm-hmm. And I'd love your take on it, Rod. Like if, and let me just be clear, we don't like infinite banking. I mean, we have some elements that we believe in, some principles, some concepts that are good stuff, but like, infinite banking is not our thing. So sometimes I see it out there in the digital world, people taking this hard stance that it's like, and maybe this is the better way to say it, and I'll let you respond. The only good use of whole life insurance is if you're using infinite banking. That's kind of what I hear out there at times.
Yeah. Yeah. So well,
what's your take?
Let's maybe define infinite banking a little more for people, because it is using a whole life policy, should be properly designed in the way we're talking about it, maximum cash value, minimum cost. So you have as much in your cash value as possible. You take a loan against it. And in the infinite banking world, they're saying the value is in the fact that you have a loan against your policy, because always and forever, you'll always earn more in your cash value than the interest you're accruing on your loan. And that's why there's value in having the loan. So if you are going to spend money on anything, you should put it in your policy first and then take a loan against your policy and go spend the money that way, because now you've created a situation where you're always going to get that kind of arbitrage, right? Mm-hmm. And the reality is that, number one, that arbitrage doesn't always exist. You're not always going to earn more in your cash value than what you're accruing in interest on your loan. Interest rates kind of determine that. And our angle on it is, instead of just, I don't know if settling is the right word, or just being okay with the loan by itself creating all that value. Well, what if I'm using that money to go out and invest and create value somewhere else? Well, if that's the case, then I can turn my 10% returning note fund into a 13% return, because the extra value I get by having used the investment optimizer strategy. So am I getting value from the loan? Yes, but I'm not just counting on the loan by itself to do that. I'm using that money to create additional value somewhere else. And when I do that in conjunction, and I get things like paying simple interest on my loan while earning compounding interest in my cash value, now I take that arbitrage to a completely different level. And then in that case, it doesn't necessarily matter as much if my interest rate that I'm paying is lower than the interest rate that I'm earning, because compound versus simple turns it in my favor, even when there are times when I'm paying a little more in interest on the loan versus the interest I'm earning.
Yep, that makes sense. The way I view infinite banking is more more of a marketing strategy than anything else. But if you were to take and break down the principles that are being used there and then apply them in the types of ways we're talking about, then you get like a really valuable thing from it. It just is convoluted by a lot of the kind of marketing hype that goes with it and the mantras that people are saying without really thinking about it, right? Like the idea that I have to use a non-direct recognition policy. Like that's just something that was said, and it's like it's just almost a mantra that gets put out there without actually breaking it down and thinking about the why and whether that actually
the other implications. Yeah, right.
So, okay, Rod, number 6, it takes 10 years plus. Maybe I'll say it this way. It takes a long time to see any flipping cash value in whole life policies. I can't wait a long time. So that's my problem, Rod. What do you think?
If anyone is showing you a whole life policy where it does take 2 or 3 years before you have any cash value, and it takes 12 to 15 years before you break even, before you have as much in your cash value as what you've put into the policy, that's not the one you want. At least not for, again, for cash value purposes. If the cash value is what you want, then no, because the way that we're designing them, you have 80% in your cash value in year 1, and you're breaking even by year 5 or 6. So even including all the costs and everything, kind of higher already costs on the policy. So
yeah, but the problem is that the reason that this is out there is because of this whole design element that we talked about earlier. Right. The reality is it can be designed, the cash can be designed so poorly that this comment is actually true. So there's truth in it. And yet the way that we're designing it. And so again, if it's designed appropriately for cash, then this will absolutely not be true. But the difference between them, as you can see, there's a huge difference between having $0 in my cash value or 0% in year 1 and having 80%. Like, obviously that is a massive gap. And it kind of makes sense why like the marketplace ends up being so convoluted about this, because actually what's happening is everybody that's speaking that is accurate in their own way, right? It's not always this, it's not always that. It really depends. The situation is the boss again, or in this case, the agent is the boss who decides to design it. So again, if you're somebody who's talking to any agent, we just do it this way 100% of the time. Like there's no time that we don't make sure policies are designed for maximum cash value. But our hope is that if anybody's hearing this and it runs into one of these situations, they can have the confidence to know that that's not the type of policy I'm looking for.
Yeah. And it is a niche thing, because if you just go to the average agent down the street and you say, hey, I heard these guys talking about whole life, they're not going to know to build it the way we build it. They'll just give you the vanilla policy that takes 10 plus years to break even. Right.
Yeah. And you really don't want that. Like you put the caveat there, Rod, on that if you're looking for cash value buildup. But the reality is like a policy that's just a base design whole life policy, there's a number of better ways to do it. That aren't that, no matter what. So that's like never an okay option in my mind, just because, I can think of 5 ways that we could create something that did the same thing and more, but did it better and more efficiently. So anyway.
Agreed.
Okay, Rod, next one has really gotten under my skin lately.
Okay.
Because I've heard it from 3 separate people on LinkedIn. I had some LinkedIn posts that went out, and especially when I had some viral posts that were like financial advisor related. I mentioned that. I've had some viral posts lately that were not financial advisor related, but one of the things that I've gotten a couple of times here is this idea that it's only for the ultra wealthy. So they're like, okay, this is usually what it looks like. It's a financial advisor, CFP, and they're like, oh, I wouldn't use life insurance as an investment. And then they'll say like, okay, well, this strategy can definitely make sense for like somebody who's ultra wealthy, who fits into that category. And then my automatic response is, why would it be any different? So if you're telling me that if I'm ultra wealthy, I should be able to instead of getting the 10% return, I should be able to turn that into 13. But why shouldn't someone that's not ultra wealthy be able to turn their return into a higher. It doesn't make any logical sense to me, Rod.
Yeah.
If the concept works and is real and work, like, then it just is. It doesn't matter what stage of life, or like, we have a specific market that we focus in on, that we market to, because that's our ideal client. But we know that this can still be extremely valuable for somebody making less money, because at the end of the day, it's the underlying principles that are valuable. Has nothing to do with wealth or net worth. Like, maybe the one caveat to that might be, if we're talking like $100 a month type of premiums, like, you may not be able to optimize the policy enough to get the value you want out of it.
Sure.
But aside from that, like, as long as you can optimize the cash that's going into that policy, it can absolutely be used for anybody. This whole idea just tells me that the people who are saying it's only for the ultra rich have no idea what's happening. They're just totally clueless. I keep saying that. I feel like this is like an ongoing theme. But in that case, man, it just gets under my skin, because if you're willing to acknowledge that it's strategy, the concept is proven and works for one group of people, there's just no reason that I can come up with why it wouldn't work for another group.
Yeah, I totally agree. Because I think they're coming at it and saying, oh, if they need death benefit for estate planning purposes or whatever, therefore permanent insurance can be valuable. But outside of that, nobody ever needs permanent insurance, right? Like, nobody.
Oh, and the other one that I hear, or this is a variation of this, and this is, okay, it can be really valuable for people once they've maxed out all their qualified plans and that kind. If they've got all the qualified plans maxed out, then we can go to that. And again, I just break it out and I say, let's just, like, instead of making jackassery blanket statements, let's just take a step back and determine what each strategy that we're looking at actually does. It's just a cost benefit analysis, man. It's just a pros and cons looking at it. And then you could quickly realize, well, we could go into the whole whether to defer taxes. But I think most people believe, and this is what's ironic about this messaging that's out there from the traditional financial planning world, is I think most people believe that taxes are likely to go up, and they're still being told to put money into to defer their money with the idea that they're going to have more. It's absolutely ludicrous.
Yeah.
Anyway,
yeah,
that's how I feel.
There's more packed in that question, in that myth than when we thought. Guessed. Yeah.
Okay. It's not only for the ultra rich. That's the truth.
Yeah.
Okay. And this next one is really tying into number one, but I think it's good to just, like, make sure we hit it on the nail. I'll get a better return in the market. Truth or false? True or false? The true or false on this one is, it's not a true or false. It depends. As I talked about before, the market, it depends on the time frame. Like, if you took a 10-year time frame, and that 10-year time frame, the end of that was 2008, and you compared it to the previous 10 years on a life insurance contract that was just humming along at 6%, getting a 8 or 9% tax equivalent return, like, I'd probably feel great about the life insurance. On the other hand, if I was looking at 89 to 99 at the end of the tech boom, I'd probably feel like the market was the better place. So the reality is that it has less to do with which is better. It has more to do with our individual goals, objectives, and, like, really what we're trying to accomplish. That's going to be what drives this kind of thought more than anything. But the premise of it still bleeds out of buy term, invest the difference, right? It's like, don't put your money in life insurance because you can get a better return in the market. That is absolutely a true possibility. There's also the possibility that you could put the money in the market and end up with a much worse return. That's just the reality of it.
Yeah. And one of the reasons is because the run up of the 90s had people putting crazy amounts of money into stocks for companies that never should have but they were not worth putting it into. We know because they busted a year or two later, right? So the other side of that is that our emotional approach to investing works against us as it relates to this comparison, because the reality is, if the market says, like, if the S&P 500 says over the last 50 years that you would have gotten an average return of 8.6% or whatever, 9.6 if you include dividends or whatever, the different things they throw out there, the average individual is not getting those returns for several reasons. Number one, because they're not 100% in stocks. Number two, because they pay fees, especially inside of a 401k or things like that. And number three, because of the emotional side of it, so many people don't buy low and sell high. So often they buy high, sell low, or do something other than that. And so the statistics actually show that if again, I don't know what the exact number was, but if the S&P did 8.5%, the individual investor on average did 5.5%, or something much lower than that.
Yeah, I remember the study, and I almost had the name of the organization that creates this consistent study that they put out there.
Yeah.
But the idea is, again, just showing the gap between markets and individuals. And we do have to recognize that. Now, I'll say this, if I'm investing for the next 20 years for growth and I'm investing in some type of qualified plan, I'm probably going to be in the market over
Yep.
life. It's like, I think that as long as I've got a long-term horizon and I can not be overly emotional, like as long as I know I'm not going to be the person that's like trying to, time the market, that kind of stuff, then I have no qualms with the idea that if I'm just saying a life insurance policy for the next 20 years in cash versus putting the exact same amount of money into the market, I would expect that over a 20-year time frame, I'm likely to have more money in the market. But I want to make sure that's clear. I'm likely to. It doesn't mean I definitively will. It means I'm likely to. Now, what we typically say is instead of putting all your money in the market, let's add the alternative space into the mix. So, the way that we do it, right? We have market money, but the only market money I use is in the places that like the deferred comp plan where the companies that we work with put money in for us. And it's still valuable. I like that money. It's great. And I expect it to get a long-term great return. And yet what we're really suggesting is that we go to the alternative space. You have to move to the alternative space. And then once you do that, then the life insurance just makes complete sense in conjunction with, and you're no longer even comparing. You're not even having a comparison point of which is the best investment, right? Because your investments you're going to be optimizing them with the policy. It's going to be a holding spot. It's not going to be the investment.
Yep.
Okay. There's a lot there. Okay.
Well
So number 9, life insurance agents just want commissions. They're all no good, sleazy salespeople. Rod, what do you have to say about that?
Well, it's an interesting. So basically what they're saying is that the truth behind it is that there is an inherent conflict of interest as it relates to this, and it goes to the design, right? If I'm an agent and I am focused on, well, what pays me the highest amount? I don't care what the client gets, but what pays me the highest amount? I can design a policy to pay me more. The client gets less in their cash value, right?
Yep.
Or if we're saying, no, we're always going to be optimizing the policy, lowest costs, which includes what we get paid, highest cash value, which benefits the client. Well, then, yeah, am I getting paid? Yes, I am. But the design or the approach, it's not about how much I get paid. It's about making the most out of the policy for the client. So am I the sleazy sales guy that just wants the commissions? Well, I want to make a living, right? And that's how I'm going to do it. But the problem is that when you flip it around to whoever it is that's speaking, you say, oh, well, you do whatever you do, right? You're an attorney, or you're a doctor, or you're a whatever.
Right. And you just want to make money.
Yeah. You make the diagnosis and then you do the surgery, and then, you know what I mean? Like when you follow down the trail and you say, well, the fact that a conflict of interest exists, hopefully in most cases doesn't mean that you're just always taking advantage of that and always recommending people should have surgery, even if it's ludicrous, right?
Well, so at the core of it, it really comes down to the person's values, which, can I just tell you, is in almost any situation
Right.
you're dealing with in a business world. If I'm investing with someone, they better have good morals and values. If I'm being sold life insurance to, if I'm having somebody write me a will or do my surgery, I need those people to have good values. And so in any of these situations, I'm required to come in and do my due diligence, understand the situation, and pick the best option with the understanding that I have. And sadly, in all of these worlds, people do get taken advantage of in certain situations, right?
Mm-hmm.
Like, I mean, I love dentists in general, but my brother was telling me a week or two ago about how he went to a dentist and he went to 2 separate dentists. He got a second opinion, and the second dentist was like, what the heck? Like, they were way overdoing what you needed.
Wow.
And
Yeah.
and so like this happens day to day everywhere. Unfortunately, it also happens in the life insurance business. Our hope is that we're providing enough education, enough context that it won't be happening to you.
Yeah.
You know what I mean?
Yep. Totally agree.
Okay. I don't need it. My investments are doing just fine. So basically the thought here is like, well, why would I use life insurance? I already have investments that are doing great.
Mhm.
And again, even after they've like seen, like sometimes it's funny. I probably shouldn't be judgmental because people oftentimes are coming in with like very little context, or maybe they don't know the life insurance world.
Yeah,
But it
seeing it
is
for the first
funny
time.
at times when people come in and they see our material and then they say that. But it
Mhm.
happens,
Mhm.
right? So the reality is here, the idea is not to replace investments. I say that because, you know, most of the time we're like our most frequent core strategy is optimizing alternative investments, right?
Mhm.
That's the thing
Mhm.
that we do more of than anything else. And so in that specific strategy, there's no replacement of investments.
Yep.
The idea is that it's an and asset in that way. I have the life insurance and I have the real estate. I have the life insurance and I have the oil and gas. I have the life insurance and the whatever it is.
Yeah.
And that life insurance is quite literally optimizing the return that I get off of it. We keep going back to the note that goes from 10% to 13% over this exact same 15-year time frame. We showed it in one of our webinars, and it's like a $211,000 difference over that time. Like it's massive, right? So again, this is just the message that we're always going to be preaching. It's both. We don't want to replace the investment. We want to do both. Now, when we're talking about capital avalanche strategy, that is more of a replacement, right?
Yeah.
It is more, we're using that as the driving force. Like in the investment optimizer, we're using the alternative investments themselves. They're the driving force behind the returns that are happening. We have the flexibility and the consistency of the policy doing its thing, but it's really being driven from the outside investments. When we get to the capital avalanche, that does change up a little bit. And now we're talking about utilizing the features, benefits, structure of the policy in conjunction with leverage, bank leverage, or outside leverage to then amplify the returns that we're getting in it. And so either way you shake it, that it's very much I shouldn't say that. So it's very much an and asset in the investment optimizer. It is an and or, but it's doing something very different than like most, like the best alternative that you could, or the best not alternative, the best comparison that I could come up with would be like a Roth IRA. But the problem is I can't fund a Roth IRA with $100,000. You know what I mean? I might be capped out. Like, even if I'm funding a Roth 401k, I'm not going to get anywhere near that kind of money in there. So the value in that situation, or the leverage.
Yeah.
Okay, I didn't mean for this to become a conversation on all the strategies, but the reality is that it's kind of a silly one, just because regardless of the strategies that we're talking about making them amplify the other things that we're doing. And in the cases that we're not, we're talking about creating another funnel that supplements or kind of builds together the full picture, right?
Yep.
It's never a replacement. We're never saying only do the capital avalanche and don't invest in alternatives.
Right.
We're saying this is all together creating our kind of core plan. Okay. Would you rather, Rod? We're getting these ones. I want to keep them light, Rod. Like you could probably dive into these, but we're just going to keep them light. Okay. So would you rather, Rod, max fund your policy at $100,000 a year, or put $30,000 a year initially in the first year and then ramp up later? Okay, so this is one that we actually get all the time. Talk about maybe why and break it down really quick, and then which one you would do.
Yeah, so this usually comes up for somebody who often they're early on in their investment world and they're saying, hey, in this case, I'm putting aside $30,000 a year for my investing at this moment. But man, within the next couple of years, because of my income increasing and or just the success of my investments, I expect I'll be able to do more than 30,000. So would it be better for me to set up a policy where the most I can put in is 30,000, or set it up to where I can put in where the
100,000
capacity is 100,000, but I'm starting and only putting in 30. And typically my answer is, well, let's start at the 30 and build from there. Because I can optimize. I have more in my cash value I get more of the 30 that lands in the cash value if I build it that way, and as opposed to building it so I could put up to 100. Well, that means I have to build in more cost, and so less of my 30 actually lands in the cash value. It can be used in that year. So let's start with the 30 and then build it from there. If in a year or 2 or 6 months I'm ready to do more, well, great. Well, then we can add another policy. You keep the one you already have. We stack another one on top of it to increase your funding capacity, and we build it out that way instead.
So the caveat to that is if you are certain it's going to be within the first year, right? So yes. One of our philosophies is max fund the policies in the first couple of years, and the policies will run great forever at that point.
Yep.
So our focus is, as long as we do that, we're in good shape. So what we don't want, though, is a situation where someone's saying, hey, I can put in the $30,000 now. I think in 6 months, I should be able to get another 70 grand in there to max fund it. Well, in that one, we might want to say, well, let's pull it back a little bit. Let's figure out what you're really comfortable you can do, and let's roll with that number.
Yep.
Okay. Next one, Rod. Use your policy for tax-free income or for legacy. I'm going to take this one. It's really easy.
Okay.
Both. We're just going to do both. I'm cheating. It's not an either or situation. We're going to do both. The nice thing is you can do both. Now, that being said, they do impact one another, right? Sure. So if I take a bunch of cash for retirement income, I'm going to have less legacy. If I don't, I'm going to have more. That's the trade-off that I play there. But at the end of the day, I'm actually almost definitively, unless I were to blow up my policy entirely, I am going to get both of those things.
And the nice thing is you don't have to decide that today. You get to decide later. Am I going to take the income in? So I start the policy now. In 20 years, I'm asking myself the question, am I going to take any money out of the policy for income or not? I get to decide that at that point in time.
Okay, Rod, and our final would you rather before we wrap up for today, $2 million of death benefit with lower cash value or $1 million of death benefit with higher early cash?
It's all about you.
That sounds easy. Sounds easy.
It does sound easy because almost all the policies we write are lower death benefit with higher cash value, because that's the goal. Yep. If you tell me I'm not as worried about the death benefit or as about the cash value, I'm more worried about the death benefit, then I'm going to fundamentally change my approach. Because like we talked about earlier, I'm not just going to say, hey, we're going to give you a whole life no matter what. I'm going to say, I'm giving you the whole life if you want the highest early cash value. But if you come back and say, well, I'm not as worried about the cash value in this policy, let's focus more on death benefit, then I'm switching to a different product.
Totally different approach, right? We might be using term insurance in conjunction with it. We might be using universal life that's just focused on death benefit and minimizing cash. So yeah, you're absolutely right. So in this situation, I hate this, man. The situation's always the boss, Rod. But in this situation, I shouldn't say this situation, depending on the situation, you would decide whether you wanted the high cash. But to your point, we would almost always go high cash value, and then we'd likely supplement it with something else.
Yes.
Right? Whether that's UL that's basically acting like a term to age 120, or whether that's term insurance because I only need it for a buy-sell for the next 10 years, whatever.
Yeah.
Any of those things apply. Okay, Rod, I'm all life insurance out for today. This has been tons of fun. Thanks everybody for listening. Give us a 5-star review on Apple. We appreciate you. We'll talk soon. See you next week.
Thank you for listening to the Money Insights Podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights Podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.